So it's FOMC time, as you know. It's the second time you've seen my face today, but we're going to now wait around for this Jerome Powell press conference. And while we're doing that, we're going to talk FOMC. I've got a couple of guests here with us as well. We're going to look at some charts. We're going to hunt some shorts. We're going to hunt some longs. We're going to see what they dish up to us tonight. So lots happening here, guys. Lots to talk about. Let's get into this. And remember, I'm normally on Banter Plus. You're seeing me on the Banter main channel at the moment. So naturally hit the like, hit the subscribe, hit the bell, do the thing. And remember, if you like this type of action, you can find me Monday to Friday on Banter Plus as well as Sundays. Let's look at Banter bubbles just for the day quickly, just to see where we are. And in fact, let's go into, this is our 1 hour chart actually that we're watching. So, so far, decent response to the 25 basis points that we've just seen has come out. Now, this was relatively expected. I think it was 100% odds, give or take, that they were going to give us the 25 basis points. I think the key now is going to be how the speech, what is going to happen in the speech. Is he going to be hawkish? Is he going to be dovish? And is the market going to bleed out? So I've got a couple of guests here to talk about these things. But my current feeling is we've had the Trump pump. Okay, that was beautiful. We've had the pump for the 25 basis points. We know the macro conditions are amazing, but is it time for a short-term little cool-off in the markets? Let's see what some of the other guys have to say. Let's ask Rainbow Ray. Well, Ray, where's your rainbow, bro? Where's the rainbow?
Right now it's rainbow.
No, it's rainbow, bro. Rainbow. Let's ask 𝗔𝗦𝗜𝗓𝗓. Guys, you remember 𝗔𝗦𝗓𝗓, our Bybit competition winner. And he's a beast of a trader. And I thought he's the perfect guy to have online tonight while we wait and see what is going on. So, Davey, what are you thinking at the moment? What are you looking for?
Man, I think it can go either way. But it's like we see the same story every time. Whatever big move happens, counter trading, it seems to be the successful route. So I don't know if it's going to go up first, down first. I think I'm going to snipe the big move and counter trade it.
Yeah, so we were saying offline that the best play might be, let's wait and see. If we get a guard candle here, it's probably a short opportunity. If we get a massive dump here, it's probably going to be a long opportunity of some of these levels that I've been prepping you guys for in the previous show today and yesterday. So there's a little bit of news floating around. Let's while we're waiting. So this the press conference is only in 10-20 minutes. So we're going to keep this we're going to keep our eyes on this thing for now, but we're going to talk Bitcoin. We're going to just talk about what is going on out there. So I mean, look, it was 100%, 98% or whatever the 25 basis points cut that we're getting, and you know what, that's what they've given us. So yes, macro stuff, super bullish, everything's looking good. We also saw earlier today $2 billion tether print. That is relatively bullish things for us, obviously. And I see Joy saying Ray is bearish. Dumper for pump from Rob. And I'm actually going to bang out a poll here for you guys as well. I want to see what you guys are feeling out there. And 𝗙𝗢𝗟𝗟𝗓 just telling us what is going on, the current situation. S&P 500 rising towards 6,000 like the bull market has just started. Gold prices are back above 2.7 like the Fed is pivoting. Oil prices are falling towards 70 like inflation is over. Tech stocks are rising. The VIX is coming down. Remember that volatility index, that thing is coming down. That tells us risk on time as well. Treasury yields are falling like rate cuts are coming. Full risk mode on in the market. So the current feeling here, from my side is maybe a short-term pullback here, but I mean, we maxing long here. I think bigger picture. And that seems to be the sentiment out there. What about Rainbow Ray? He's made his way back. Welcome back, sir.
Welcome back.
Ray, max long, max short? Where are you, bro?
I'm short now. I'm short. Stop loss is the top.
Okay, Ray shorted BTC. Stop loss on the top. 2 hours ago, we shorted Radium. Okay, Radium looked a little bit hot. Here's Radium. Okay, we shorted Radium together on the show earlier. And there we go. So it's wanted to fall over. Okay, that was a banger call, Ray. As we went live, we shorted Radium. So Ray was thinking Radium was going to fall over there. So currently I'm short Radium here on ZoomX and I'm still long BTC. Hopefully going to be max long. Hopefully we're just going to send this thing straight to Valhalla, yeah. But, maybe a couple of bumps along the road. So a little bit of other things going on. Michael van der Poppe, interesting comments here as well. And this seems to be my sentiment too. He's saying it's FOMC day. He thinks Powell remains to be hawkish, though, which a short pullback seems normal. what to do with such a pullback? Look, it smells like a bullish pullback. Okay. I mean, for me, we've covered a lot of these charts. And while we're talking now today, while we're waiting for these things, we're going to look at BTC. We're going to look at some of these altcoins as well. And guys, remember, just drop in the chat. So while we've got time to chat here, just let us know what tokens you want us to look at. And maybe DJ and Dave can give you some of his special sauce as well. So just drop a couple of tokens there. And I see Maudo wants some ADA action as well. Look, I think ADA is going to have its day as well. We think that thing is going to come back. Let's talk BTC quickly. And then I also want to discuss this current ETH strength that everybody has noticed, and this possible rotation from Solana back to ETH. I mean, that's looking pretty interesting. But let's go BTC now. So this is BTC on the 1 hour, and you know us degens, we like to watch lower time frame candles, and you can see as we start moving up, we just keep raising this fib. We just want to track the price to the highs because we want to try and understand where our solid reaction zones are at the moment. So at this current situation that we are in, 74,300 is our first reaction zone that we're looking at. If we do get some kind of pullback here, then a little bit lower down, you can see our hot zone, 73,600. So any one of these could be one of these reaction zones if we get a sharp move to the downside. And then I've got an absolute banger here. I've got an anchored VWAP tied in with a 382 and some horizontals here just under 73K. So that is a nice, interesting zone there for us on any downside. So hunting for one of those. And it's tricky now, Dave. All-time highs. There's no levels to bet against if we're looking for shorts.
Oh yeah, we are at uncharted territories at the moment.
Let's take a look at, I see there's a comment from Andre about the liquidation heat map. Look at this thing. It's an absolute mess. Okay, let's just refresh this one to see where we are. Okay, looks like a ton of liquidity to the downside. Look at that, 74,000. Okay, tons going on there to the downside. Upside, 76,900. Okay, that type of level, you can see little hunt maybe up there for us. So it remains to be seen what is going on here. But okay, so BTC, we've got some key levels now that we're going to watch. And we do have a 15-minute degen chart. Well, we got to get it ready. Let's get our 15-minute degen chart out so that we can watch the action while it unfolds. Let's get our finance perks out here. Let's go 15 minutes. Okay, this is the action chart. This is the action stuff. This is where we can get some decent reactions as well. Okay, and then I am locked and loaded. I'm ready to go here on Prime XBT as well. I'm just dying to click buttons here. I'm dying. Okay, I'm waiting for Ray. Also, Ray gave us a good radium trade earlier, so we're going to see if we can catch a little move just now. So Ray, keep us posted. We know those of you who watch the show, you know Ray likes his 3-minute candles. He's got some secret sauce there where he figures these things out. So we're going to hang tough there and wait on. While we are talking here, we've got a few more minutes to go. Let's just talk ETH because ETH has now really just started to shine. And funnily enough, I closed my ETH trade at this horizontal resistance band. Now, ETH has made a massive break for us, and it's quite exciting for the whole ETH and the ETH ecosystem. We're talking ETH plays like Arbitrum, Optimism, Lido. We're talking big DeFi plays, Uniswap, Aave. Those types of things could really start getting a little bit of energy now. And you can see this ETH is looking super hungry here. Dave, do you have any ETH plays running at the moment?
I've been watching it. I was watching 𝗏𝗏 yesterday, so it looks like it just broke that trend, did a 382 retest. Pretty nice.
Yeah, I mean, this 𝗏𝗏 is an absolute banger here. If you guys like an ETH play, I mean, 𝗏𝗏 meme coin, I mean, that is something to go on. I've got a little 𝗏𝗏 running here, and you can see I've just opened a 𝗏𝗏 head short. Well, not just a little bit earlier on my show, and you can see. So I'm long 𝗏𝗏 at 29K. I've got a head short in play, and my strategy here on Bybit at the moment is to hold this 𝗏𝗏 position through any types of pullbacks that we might be getting. So you can see I've got a ton of limit orders set here on 𝗏𝗏 while we're waiting. So if we do get some kind of dip, all these limit orders are programmed here to start buying on any moves to the downside. So we really want to start growing that 𝗏𝗏 position size if we get a little bit of downside, and then the head short play just to pay some bills on the way down, you know. So could be something nice for us there. And I'll show you guys this 𝗏𝗏 chart here, and I'll just show you the strategy behind what I'm thinking here at the moment. Let's just grab this 𝗏𝗏. There she is. Okay, so we're looking for bullish types of pullbacks here. Oh, where's our 𝗏𝗏 gone? Where's our 𝗏𝗏? No, 𝗏𝗏's left us. 𝗏𝗏's left us. Okay, let's get it back.
Why is Robert so salty?
What's wrong? Robert, come on, bro. Just be we're just realistic here, bro. Come on. Don't be like Robert, I'll give you the bullhorn, bro. I'll give you the bullhorn. I'll give you the bull.
Show him the radium show.
Robert, hey, bro. See, we shorted radium, but it's a short-term short. We're super bullish here, bro.
Right, it's super bullish. We're bullish.
Short-term short.
Stop.
Okay, wait. Charts aren't loading there, guys. Okay, let me take this off. Let's talk shit while I load my charts here a little bit. Okay. Ray, talk. I'm just trying to sort my charts out here for a second, and then we're gonna get this press conference started.
So it looks like this radium short is about to make new lows. Bitcoin's rejecting a little bit here, but it's looking like it's having some good support.
Yeah,
it's having some buyers.
You remember, guys, he's watching 3-minute candles. So when Ray says it's on good support, it's 3-minute support. It's 3-minute support.
Yeah, it could just flush through. But you can see the emotions on the 3-minute. You see the emotions of the market. But the RSI is definitely cooked. It's definitely cooked on the small time frame. That's why I'm just looking for maybe like just a 1% pullback, maybe even 0.75%. That's my plan. I just scalp, jump in, higher leverage, tighter stop. Radium making new lows.
Okay, I've got the Peppy chart. Robert, come on, bro. We're not trying to short anything. Okay, let's just talk Peppy. So you saw my little strategy there. Now, this strategy is specifically if we get some kind of pullback. Now, we're not saying for sure. Nobody actually knows what we're going to get, but what we can do is be prepared in case we get those types of situations. So that Peppy example that I've given you is if we do get some kind of bullish pullback. Now, I'm expecting a bullish pullback. I'm not expecting new lows on these altcoins or anything along those lines. So ideally for me, I've got buys set out on Peppy, that zone over there. Okay, massive hot zone here for me, and a little bit lower, another one order there and another order down there. The idea is if we start dipping, we're just going to clip off buys in those zones. One of those should be the bottom if these things are going to remain bullish, and then we'll have a nice big size position to start sending higher. I see Stain says Rainbow Ray is looking sexy. Well, let's see. Where's our press conference? It's coming. It's around the corner. 10 more minutes, guys. Okay, let's see what else we had today. We had jobless claims today, and pretty flat. So no major movements out of that. And I did a poll earlier, and I'm keen to hear your thoughts. You guys can follow me on Twitter at the Lord of Entry. I did a poll today. 69% think we're going to see 80K this week. Okay, this week ends on Sunday. So yeah, maybe Davey, 80K
would be nice.
Pleasant. Look, okay, 80K this week. Let's go. Let's see what else we got here. Where's our news? Okay. Let's get our
Look at this 3-minute red candle.
There we go.
It's that 1% move I was looking for.
Just let it come down.
Let's go.
Yeah, it looks like it's just a little bit of a sell-off right now. Some selling happening. Get that bullish pullback.
Look at the reaction at 75,500, guys. That's the VWAP. Something's gonna happen.
Guys, while we're waiting here, don't forget Banter bubbles. If you're not using Banter bubbles, well, it's way more than just some bubbles with prices in. If you click on the right-hand side, you get right-hand top corner here. You can see our newsroom. Okay, tons of researchers there, including some of my posts going in here on a daily basis. So you can follow all the latest up-to-date news that is floating around in the markets here on the newsroom. And don't forget, you can also win a Bitcoin. All you need to do is be trading on one of the links in the show description there for Win a Bitcoin. And if you click on Win a Bitcoin there, you can see the exchanges there, Bybit, Blowfin, BitGet as well. CoinW is there. And basically, you want to guess the price of Bitcoin. If you get it right, you get 0.5 BTC on the 1st of January. If you've actually taken trades and you've traded or taken 10 trades in your account, you'll get an extra 0.5 BTC. So have a crack at this thing. And this is January 1st. So, I mean, this is a tough one to call. I mean, where are you January 1st, Davey? 100? 90? Where are you January 1st?
I don't know. I mean, don't know if you remember back 2017 whenever Bitcoin was at all-time highs, Asia sold the crap out of it during this season's Christmas holidays. So, man, I don't know. I'd like to see higher, obviously, but
I've got McFly DD 129. We've got David Bond 119,000. We've got Gallus at 98K. So there's some bulls here. There's some bulls, and I like Guided Shark. This is Guided Shark. Look at this, 64,799. Okay, that's a bold one. That's a bold call there. 64,799. But mainly big numbers here. I think a little bit bullish this feed here, guys. A little bit overly bullish here. I see there's some more reds here. 73K. That's relatively balanced, but some lots over the 100K mark there.
Everyone's bullish.
If everyone is bullish, guys, hey, what happens if everybody's bullish? Ray knows the story. Ray knows the story as well. He knows the thing. Rainbow back. While we're waiting, guys, some altcoin levels. If you want to get ready, if you missed the show earlier today, some levels that I'm watching. This is Doge, so the Department of Government Efficiency now. Okay, that's probably going to be official. Levels for Doge that you want to watch. If we do get some push down, 0.18. 0.171. These are the hot zones that I've got my eyes on here. These types of levels, this is where we get a little springboard effect. If we do push into those zones, any one of these could be a nice little banger zone for us. So if we get a meltdown here, those are the types of levels you want to start paying attention to. I've got similar things for you on AVAX as well. You can see AVAX lower high. Okay, so that is not a good look at the moment. Little reversal here on AVAX at the moment. See the rejection of that 200-day moving average. Lower high now. Let's see. Okay, AVAX traders, 26.67 is your support. 25.8 is your next support zone that you're going to be watching. So at the moment, not a good look. This lower high, maybe something along those lines could be playing out for us. Let's see what type of candles these guys are going to dish out for us. And I've got one or two others. Phantom traders, I've got this one ready for you as well. This is Phantom on the 2 hour. And interesting things happening here with Phantom. It's looking pretty bullish, but keep in mind, we are at a major resistance band at the moment for Phantom. So a little bit of a danger zone there, Phantom traders. So if we do get a pullback, for me, there's a nice buy zone here. There's a nice long for you guys on Phantom, 0.667, 0.668, 667, that type of region. Maybe just stick an alarm on there. If we do get some kind of sell-off, that could be a nice little reaction zone for you guys. And then Sol, obviously, I mean, Sol's been insane. Okay, but suspicions that Vamsy, my shorts are good, bro. Do you want to see them? Let me show Vamsy. There's Radium. Wait,
I don't understand.
There's Radium. Okay, there's Radium.
You not believe us?
Let's go.
And there's I've got some shorts running here. Peppy, I've got Injective, I've got Sui, and then I got Tower. So Tower is the short as well that I'm in there. And I don't think I have enough positions. I was saying maybe I need a few extra positions here at the moment. But yeah, shorts are okay so far. And remember, the idea here is short-term shorts that we are looking at. We are max long, okay? As you can see, we are max long all over the place. And, if you're a degen trader, you like to trade some of the moves. And that's what we like to do. So sometimes we get it wrong, obviously, but when you get it right, it's lovely. While we're waiting here, guys, we got 5 more minutes. There is a ZoomX trading comp at the moment that is exclusive to my show. They've been kind enough to extend it for us. So I've got 117 people trading in my competition. There's a $22,000 prize pool going out to the top 10 who finish in the top 10. All you need to start this competition is $150 in your ZoomX futures account. So have a look if you guys want to trade this with me. C Bros, he's leading. He's got 247%. And he's going to win $8,500. Maruk, she's in Sniper Club with us. She's 189% up. She's going to win $5,000 if she finishes there in the top 10. And I'm trading PopCat only for this competition. And I see some of the other Sniper Club members are also trading PopCat. Pussy coming in hot. That's only PopCat. And this pussy is hot is also only PopCat. And mine is PopCat is a good kitty. And I'm busy working on building a big PopCat position there at the moment. So right now it is green, but I've been adding on all these levels on the way down and trying to just build the size on PopCat. So hopefully that'll take us through and really get us into those into the top 5. Let's see. Brett says massive dump. I don't know. We get a massive dump. I don't know. Maybe a bullish pullback. We'll call it bullish pullback. Let's see what we got. Zedson says de-risk, then re-risk. I like that. I like that a lot. And Marky Mark says flat during FOMC. Guys, I think that's a reasonable assumption. Okay, if you're not in any positions, let it play out. Let's have a pump for a short, or let's have a dump for a potential long. I mean, ideally, we want to see some kind of dump. That's going to give us a nice bullish entries. Anyway, I think that is pretty much what everybody wants to see. And DB, we did discuss 𝗪𝗡 on my show earlier today. We covered it nicely. There's 40% move to the upside for the next major resistance zone. Basically, you want to now try and snag a little entry on 𝗪𝗡, ideally on some kind of short-term little pullback, or you're going to be trading some flag breaks on that 𝗪𝗡. So I did cover it on my show earlier on Banter Plus, if you want to take a look. And then all Sniper Club members, they get all those charts directly into Sniper Club after the show. So you guys will obviously have access to that chart there for you guys. Okay, let's see where we are. Couple more minutes here.
2 more minutes.
Ray, we're going to have to do a quick sound check there as well. Okay, let's do a poll while we're waiting. 2 more minutes, guys. 2 more minutes. Okay, I'm dropping a poll here for you guys. Okay, fill in that poll there for me. I've dropped a poll in the chats there for you guys. Let's see the sentiment here. Let's see how everybody is feeling here at the moment.
Did anyone bring any whiskey? Joint? Anything?
Unfortunately not, bro. Unfortunately not. Unfortunately not.
Do we have water? Will we be hydrated for this old man speech that affects our leverage trades significantly?
Okay, I see the votes are coming in. Keep those votes coming in there, guys. I want to see the general sentiment here in the chats. I just want to see what you guys are thinking.
Hey, some guys brought some beers and drinks in the comments. Nice. Cheers, fellas.
Here we go. Let's just the music here. Here we go. Ray, just let me know. Can you hear this, Ray?
Good afternoon.
Yeah, that's good.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has eased substantially from a peak of 7% to 2.1% as of September. We are committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the FOMC decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by 0.25 percentage point. We continue to be confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 104,000 per month over the past 3 months. This figure would have been somewhat higher were it not for the effects of labor strikes and hurricanes on employment in October. Regarding the hurricanes, let me extend our sympathies to all the families, businesses, and communities who have been harmed by these devastating storms. The unemployment rate is notably higher than it was a year ago, but it has edged down over the past 3 months and remains low at 4.1% in October. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years. Total PCE prices rose 2.1% over the 12 months ending in September, excluding the volatile food and energy categories. Core PCE prices rose 2.7%. Overall, inflation has moved much closer to our 2% longer run goal, but core inflation remains somewhat elevated. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we're attentive to the risks to both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 4.5% to 4.75%. This further recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we move toward a more neutral stance over time. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. We are not on any preset course. We will continue to make our decisions meeting by meeting. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation is not sustainably moving toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can move more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Okay, some questions coming in here.
Thank you. Given the expectation that the election outcome will produce policies that would meaningfully impact the U.S. economy next year, how is the committee taking these proposals into account for upcoming decisions, including potentially the next one in December? And can you give us any more sense of how proactive or reactive the Fed is prepared to be to changes in economic policies with the next administration?
Sure. So let me say that in the near term, the election will have no effects on our policy decisions. As you know, many things affect the economy, and anyone who writes down forecasts in their job will tell you that the economy is quite difficult to forecast looking out past the very near term. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability. We don't guess, we don't speculate, and we don't assume. Now, just in principle, it's possible that any administration's policies or policies put in place by Congress could have economic effects that over time that would matter for our pursuit of our dual mandate goals. So we, along with countless other factors, forecasts of those economic effects would be included in our models of the economy and would be taken into account through that channel.
Nick.
Chair Powell, Nick Timrose from the Wall Street Journal. Roughly 1 year ago, when the 10-year Treasury was flirting with 5% and 30-year mortgage rates were near 8%, you noted how higher borrowing costs, if they were sustained, could weigh on economic activity. Given that you've said you believe policy is restrictive and the Fed is now dialing back that restriction, are the growth risks presented by higher U.S. Treasury yields today any different from those you identified 1 year ago when inflation was still meaningfully above your target?
So I would just say this: we've watched the run up in bond rates, and it's nowhere near where it was, of course, a year ago. I guess the long run rates are well below that level. So we're watching that. Things have been moving around, and we'll see where they settle. I think it's too
no
early to really
movement
see
yet
where they
in the
settle.
markets.
Ultimately, I'm sure we've all read these decompositions of what, and I certainly have, but it's not really our job to provide our specific decomposition. I will say, though, that it appears that the moves are not principally about higher inflation expectations. They're really about a sense of more likelihood of stronger growth and perhaps less in the way of downside risks. So that's what they're about. We do take financial conditions into account if they're persistent. And if they're material, then we'll certainly take them into account in our policy. But I would say we're not at that stage right now. It's just something that we're watching. And again, these things don't really have mainly to do with Fed policy, but to do with other factors in the economy.
If I could follow up, is the September SEP, are those rate projections still valid? Do they still seem relevant given where we are now?
It's you get halfway through the cycle between the last set and the next set. I wouldn't want to comment one way or the other. Let's talk about the data we've gotten since the last meeting. So in the main, the economic activity data have been stronger than expected. The NIPA revision was stronger. Certainly the September employment report was stronger. The October report, not stronger. Retail sales stronger. So overall, though, I think you take away a sense of some of the downside risks to economic activity having been diminished with the NIPA revisions in particular. And so overall feeling good about economic activity. So I think we would factor that in. At the same time, we got one inflation report, which it wasn't terrible, but it was a little higher than expected. So I think really the question is December, and by December we'll have more data. I guess one more employment report, two more inflation reports, and lots of other data, and we'll make a decision as we get to December.
𝗔𝗦𝗡 from the New York Times. Thanks for taking our questions, Chair Powell. When it comes to December, what will you be looking at specifically as you try to make that decision? And then as of the Fed's economic projections in September, you had written down 4 quarter-point interest rate cuts in 2025. Do you still think that those are likely? Is that sort of the baseline outlook at this point, or has that shifted? And if it shifted at all, can you give a little bit of detail as to why?
we don't fill out an SEP, and I can't characterize one that wasn't filled out today. So I can't really speak for kind of exactly where the committee is. I will just say for December, we're going to be, again, at every meeting, we're going to be looking at the incoming data and how that affects the outlook. As you know, we're in the process of recalibrating from a fairly restrictive level at 5.33%. After today's move, we're down 75 basis points. And we're asking ourselves, is that where we need to be? You know that we're trying to steer between the risk of moving too quickly and perhaps undermining our progress on inflation, or moving too slowly and allowing the labor market to weaken too much. We're trying to be on a middle path where we can maintain the strength in the labor market while also progress on inflation. We think that's where we are, but that's the question we're going to be asking in September.
Bullish pullback first.
And again, I can't really update you on the committee's thinking because we don't fill out an SEP at this meeting.
Yeah, totally appreciate that. I guess when it comes to your own thinking, do you think that a full percentage point of rate cuts in 2025 is a reasonable outlook?
Again, we're going to wait and see how things come in December. I mean, it's just, I would put it this way. We're on a path to a more neutral stance. And that's very much what we're on. That has not changed at all since September. We're just going to have to see where the data lead us. We have, a whole 6 weeks of data to look at to make that decision in December. Obviously, I'm not ruling it out or in, but I would say, I would say that, again, we didn't update the SEP, so I'm not going to characterize, where the committee would be.
Howard.
Thanks, Howard Schneider with Reuters. I wondered if you could please elaborate, explain a little bit the two changes in the language of the statement here. In the first paragraph, when you say inflation has made progress, dropping the word further progress. And in the second paragraph, dropping the sentence that the committee had gained greater confidence that inflation was progressing towards its 2% goal. Is there any policy substance behind either of those changes in language? Is it meant to open the door to a December pause? Is it meant to communicate anything about the stickiness of core inflation in the last 3 months?
Not really, no. So let me tell you what we were thinking. So the test of gaining further confidence was our test for the first rate cut, right? And so we met that test in September, and therefore we take that test out. If you leave it in, then it's new forward guidance. It's brand new forward guidance. What do you mean by it? Are you requiring yet further? We have to say yes or no at every meeting whether we've made further progress. The point is we have gained confidence that we're on a sustainable path down to 2%. So that I would tell you is what that's really all about. It's not meant to send a signal. Neither of those is meant to send a further signal. And saying further progress, it becomes a test. We don't want to be. We don't think it's a good time to be doing a lot of forward guidance. There's a fair amount of uncertainty in that. In what I've said, the path that we're on, we do know where the destination is, but we don't know the right pace, and we don't know exactly where the destination is. So the point is to find the right pace and the right destination as we go. And I think there's a fair amount of uncertainty about that. And you don't want to tie yourself up with guidance. You want to be able to make sensible decisions as you go.
Steve Leisman, CNBC. Mr. Chairman, you talked about higher rates, perhaps from an expectation of higher growth. You didn't talk about it in terms of expectations of higher deficits. Is that something you think might be behind the recent rise in interest rates? And is that are rising deficits a concern to you?
So we don't comment on fiscal policy. And again, I don't have a lot more to say on what's driving bond yields. In terms of policy changes, though, let me give you a sense of how this works in the ordinary case. Let's say Congress is considering a rewrite of the tax laws. Doesn't matter what's in the content. So we would follow that. At a certain point, we'd think we see the outline. So we'd start to model it. And then we'd wait. And then at a certain point, the staff would brief the FOMC and say, these are the likely effects. There's lots and lots of literature on the effects of tax policy changes on various parts of the economy. So we try to get smart on that, and then the law actually passes, and you'd start to put it. You probably run an alternative simulation before that happens, just to keep people trying to understand it. Then when it actually passes, it goes into the model, along with a million other things. So we have a very large economy. Many things are affecting it at any given time. And, a law change of some kind would go in there, but it would, it's a process that takes some time. Clearly, the legislative process takes a lot of time. And of course, the real question is not the effect of that law. It's all of the policy changes that are happening. What's the net effect? And, the overall effect on the economy at any given time. So I think that's a process that takes a lot of time and that we go through all the time with every administration constantly. And this will be no different. But right now there's nothing to model right now. It's such an early stage. We don't know what the policies are, and once we know what they are, we won't have a sense of when they'll be implemented or all those sorts of things. So I think I would just say we're not doing that now, and all that will take time, and it will be very much regular order.
Some of the comments
when we do that.
If I could just follow up on Nick's question. Are the current rates something you feel like you need to lean against, in that they go against the direction of policy by adding restrictions to the economy?
Nothing going on, Zeno.
Given perhaps a signal
everything's flat.
Do less.
Nothing burger.
Look, I just think the first question is, how long will they be sustained? If you remember the 5% 10-year, people were drawing massively important conclusions, only to find 3 weeks later the 10-year was 50 basis points lower. So, it's material changes in financial conditions that last, that are persistent, that really matter. And we don't know that about these. What we've seen so far, we're watching it, we're reading, we're doing the decompositions and reading others, but right now it's not a major factor in how we're thinking about things.
Maybe the market's watching his speech. It's just falling asleep.
We need that one person to ask that one question.
Thank you, Chris
that creates the
Gsebber,
volatility.
Associated Press. You mentioned the positive economic data that we've seen since the September meeting, including the revisions to things like savings, higher GDP growth. We saw a stock market jump yesterday. That's renewed some of the questions about why do many cuts at all in this with this backdrop.
So you're right. As I mentioned, and as you mentioned, the latest economic data have been strong, and that's, of course, a great thing and highly welcome.
Big question.
But of course, our mandate is maximum employment and price stability. And we think that even with today's cut, policy is still restrictive. We understand it's not possible to say precisely how restrictive, but we feel that it is still restrictive. And if you look at our goal variables, the labor market has cooled a great deal from its overheated state of 2 years ago and is now essentially in balance. It is continuing to cool, albeit at a modest rate, and we don't need further cooling, we don't think, to achieve our inflation mandate. So that's the labor market. Inflation has moved down a great deal from its highs of 2 years ago, and we judged, as I mentioned, that it's on a sustainable path back to 2%. So the job's not done on inflation. But if you look at those two things, we judged in September that it was appropriate to begin to recalibrate our policy stance to reflect this progress. And today's decision is really another step in that process. Overall, as I mentioned, we believe that with an appropriate recalibration of our policy stance, we can maintain strength in the labor market, even as our policy stance enables further progress toward our inflation goal.
Great. And just to follow up, what might cause you to pause rate cuts in December? What kind of economic data would lead you to that path?
We need a candle, guys.
So we haven't, made any decision like that at all. But we're in the process, as I mentioned, of moving policy down, our stance down over time to more neutral level. And as a general matter, as we move ahead, we are prepared to adjust our assessments of the appropriate pace and destination as the outlook evolves. So, for example, if we were to see the labor market deteriorating, we'd be prepared to move more quickly. Alternatively, as we approach levels that are plausibly neutral or close to neutral, it may turn out to be appropriate to slow the pace at which we're dialing back restriction. Again, haven't made any decisions about that, but that's certainly a possibility. If you can think of it as similar to what we do with asset purchase, with asset runoff, with QT. So we reach a point where we slow the pace, much like an airplane reaching the airport slows down. And so it we're thinking about it that way, but it's something that we're just beginning to think about.
Edward.
Thanks, Chair Powell.
Guys, don't forget to fill in my
so-
poll here.
With the noise in the jobs reports that we've seen, and you look at the Fed's favorite inflation, PCE inflation, overall it's 2.1%, very close to the Fed's target, but core inflation is 2.7%, and it's been that way since July. So why doesn't this data give fuel to a rate pause for this meeting?
Well, so I think if you look at the 3 and 6 month, you're quoting the 12-month. So we look at all of them, right? But if you look at 3 and 6 month core PCE, you'll see they're around 2.3%. So we look at all of them, and we look at 12 as well. But what it's telling us is that we really have made significant progress, and we expect there to be bumps. For example, the
Guys, if you think Powell is boring, smash the likes.
readings were very probably unsustainably low. So that's why forecasts generally see a couple of upticks toward the end of the year. On the other hand, the January reading certainly looks like an example of residual seasonality, so that we saw last year. So
More Fed
when that
splaining.
falls out of the 12-month calculation in February, we should see a thing down. So it'll literally be a bump up and then down. We understand that. Overall, you see the progress on inflation, and you also look at the economy and you say, what is
I've
the
never
inflation
seen
story
such a
now? Where's it
flat
coming
market
from?
during one of these.
So I point to a couple of things. One is the non-housing services and goods, which together make up 80% of the core PCE index, are back to the levels they were at the last time we had sustained 2% inflation, which happens to be in the early 2000s for a period of 5, 6, 7 years. So they're back to that level. What's not is housing services. So let's talk about housing services. Housing services is higher. What's going on there is, market rents, newly signed leases are experiencing very low inflation. And what's happening is older, leases that are turning over are taking several years to catch up to where market leases are.
So many likes.
So
Guys, remember, if you find them boring, hit the
it's not
likes.
really reflecting current inflationary pressures. It's reflecting past inflationary pressures. So that's one thing. The other thing is, I'd say look at the labor market, not a source of inflationary pressures. Where's it coming from? It's not a very
And
tight
also
economy.
tell us your thoughts in the comments. Smash the likes. That is
That
boring, but
catch-up
tell us why in the
for
comments. I want to know.
and several other areas. So you're seeing, we're not declaring victory, obviously, but we feel like the story is very consistent with inflation continuing to come down on a bumpy path over the next couple of years and settling around 2%. That story is intact, and it won't be 1 or 2 really good data months or bad data months aren't going to really change the pattern at this point now that we're this far into the process.
So you're quickly trying to get to that neutral rate that you see, or do you foresee that you have some time to get there?
Nothing in the economic data suggests that the committee has any need to be in a hurry to get there. We are seeing strong economic activity. We are seeing ongoing strength in the labor market. We're watching that carefully, but we do see maintaining strength there. And so we think that the right way to find neutral, if you will, is carefully, patiently. Again, that's not meant to have a specific meaning, other than to the extent the economy remains strong, we have the ability to take advantage of that as we try to navigate that middle path between the two risks.
Craig.
Hi, Chair Powell. Craig Torres from Bloomberg. 2 questions today.
Come on, give us a
did you learn
candle.
anything about what Americans think about the economy from the election results? First question. Second question. I want to talk about some labor market indicators, and I do so with great respect for your attentiveness to the maximum employment side of the mandate, Chair Powell. So the unemployment rate has been at 4% or higher for 6 months. One of the broadest measures of unemployment is up about 0.5 point from a year ago. Compensation gains are sliding back. The quits rate, a signal of labor market dynamism, has been heading down to that bad neighborhood of the 20 teens. So you have put a marker at Jackson Hole saying any further cooling is unwelcome. It is cooling generally a little bit further. So at what point do we reach what you would describe as a shortfall from maximum employment? Thank you.
Sure. So on your first question, I'm not going to talk about anything that relates directly or indirectly to the election. On the second one, this is the great question, and so one we think about all the time. So I'll just say a couple things. There's nothing really surprising here. What we know is that the unemployment rate is low. We also know that it's moved up significantly from a year or so ago. So we've seen a big change upward in
Let's get some charts out while he's talking.
Sometimes that has meant bad things. So far, it doesn't appear to be. It appears that I wouldn't say that the labor market has fully stabilized, because I do think it's continuing to very gradually cool, but it seems to be in a good place. And our policy, of course, is designed to keep it in that good place, to maintain the strength in the labor market while also enabling further progress on inflation. You mentioned a bunch of indicators, and you're right. The openings to unemployment rate is back to a normal level. I would characterize it more broadly as normalizing. You mentioned wages. Wages are still running just a bit above where they would need to be to be consistent with 2% inflation, unless productivity is going to remain at this high level. If we see productivity, more sustainably at these high levels, then that would sustain higher wage gains. So I would say, in fact, you can say it the other way, that wage increases are now consistent with 2% inflation given current productivity readings. But of course, the lore on productivity readings is whenever you see high readings, you should assume they're going to revert pretty quickly to the longer term trend. That has always been the case for 50 years. But it may be that we're now 5 years. If you look at the NIPA revisions that came out a month ago,
Dave, you still awake, bro?
Into a nice set of productivity readings, which are quite healthy. But overall, it's a good labor market. We could talk about
losing my will to live
series. We'll be looking at all of them, of course. But we don't want the labor market to soften much from here. We don't think we need that to happen to get inflation back to 2%.
Victoria. Hi, Victoria Guido with Politico. Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
Big question.
Can you follow up on, do you think that legally that you're not required to leave?
No.
Michael McKee from Bloomberg Radio and Television. You talk a lot about what the data are telling you and how you are dependent on the data. But in terms of forward-looking assessments of the economy, what are you hearing from CEOs or other officials around the country? What did you hear today from the regional bank presidents about what companies and consumers think about where the economy is going from here rather than looking backwards? And does that match up with what your forecasts have been and what you think the appropriate policy path should be?
So it's hard to characterize a really interesting set of discussions we had, and of course you'll see them in the minutes in 3 weeks. But I would say this: I think the comments from our Reserve Bank colleagues and from the CEOs that they talk to are pretty constructive on the economy right now. Pretty constructive, feeling that the labor market is back to normal, to the point where it's no longer that much of a discussion topic in their worlds, whereas 2 years ago it was all they were talking about. So they feel like the labor market's in balance. People feel good about where the economy is. Demand is obviously pretty strong, and you're seeing 2.8% growth in the third quarter estimated. Maybe the year's 2.5%. This is a strong economy. It's actually remarkable how well the U.S. economy has been performing with strong growth, a strong labor market, inflation coming down. We're really performing better than any of our global peers, and I think that is reflected in what you hear from what I hear people hear from CEOs. I don't get to talk to a lot of CEOs in my job, but I hear what others summarize from those. And of course, I hear the Reserve Bank presidents do a lot of that. And it's pretty constructive overall. Now, that's not to say there are areas of caution and and things like that. But ultimately, overall, pretty positive.
Well, to follow up the areas of caution, if there were black clouds on the horizon that you identified as something you're watching, what would they be?
I think it's things like clearly geopolitical risks around the world are elevated, and just as clearly they've had relatively little effect on the U.S. economy. Now, that can change through the price of oil or otherwise, but people talk about those as something that's on the horizon all the time. But ultimately, if you look at the U.S. economy, its performance has been very good, and that's what we hear from business people, and expectation that will continue. If anything, people feel next year. I've heard this from several people.
When he finishes, Dave, dump or pump?
Stronger than this year,
as he's done.
I think there's
dump
when he's done.
Okay, are we shorting, Ray? Are we shorting here as he walks out?
I just wanted to follow up on the discussion earlier on fiscal policy. Your predecessors
Short is back to entry
when they thought
I'm slightly in the green. So
endangered
this is
species,
why I answered.
Financial stability.
Stop
Will you
loss
do that?
is the top.
And right now we're in a period of full employment. We have large budget deficits and debt at historic highs that are rising. Is that something you'd speak out against?
So, I have said many times, no more, no less than what the predecessors you mentioned have said. And what that is that the U.S. federal government's fiscal path.
Guys, let me know in the chats when he finishes, pump or dump. Let me know.
The level
we're taking a trade before this thing is over, so let me know.
The path is unsustainable, and we see that in you've got a very large deficit at you're at full employment, and that's expected to continue. So it's important that we that to be dealt with. It is ultimately a threat to the economy. Now I can say that I don't have oversight. We don't have oversight over fiscal policy. I've said it on many occasions. Just said it again.
Okay, thank you. I guess the other question is to follow up on Victoria's question. Do you believe that the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Not permitted under the law.
Not what?
Not permitted under the law.
Thank you.
Courtney. Courtney Brown from Axios. In response to Howard's question, you said it wasn't an ideal time to give forward guidance because of the economic uncertainties. Can you lay out what some of those uncertainties are and whether or not it includes some of the proposals that the president-elect has put out on the campaign trail? Tariffs, for instance?
No, I was not referring to the new administration's policies at all, nor will I today. So what I'm just saying is, as we look ahead, we know, and I mentioned this in my statement, that the risks are two-sided. I guess I should start by saying that we think that the economy and we think our policy are both in a very good place, And but as you look forward, you say, what are the risks? And one risk is that we would move too quickly and find ourselves having moved too quickly, and inflation comes back, and we lost our chance to get inflation back to 2%. So we have to avoid that risk. And that to avoid that risk, that means you want to move carefully. The other risk is that we move too slowly, and that we allow the labor market to weaken too much and do unnecessary damage to the labor market and to people's working lives. That says don't get behind the curve. So these two things are the two risks that we have to manage. And so we're in the middle there. We try to be in the middle and deal with manage both of those. Again, the idea is to support the strength we have in the labor market and in the economy, but also with somewhat less restrictive, but still restrictive policy, enable further progress toward our 2% inflation goal. This is a thing where we're meeting by meeting, we're going to be making our assessment of what the right path is. It's not as important. The precise timing of these things is not as important as the overall arc of them. And the arc of them is to move from where we are now.
He looks tired. He looks like he's had enough.
A more neutral policy. We don't know where that is. We only know it by its works. We're pretty sure it's below where we are now. But as we move further, there will be more uncertainty about where that is. And we're going to move carefully as this goes on, so that we can increase the chances that we will get it right.
Sol's doing well.
Simon.
ETH.
Nice.
Thank you, Chair Powell. Simon �値𝗏 with The Economist. I know you don't want to share your decomposition of bond yields, but if you look at the break-evens, it is clear that longer-term inflation expectations do seem to have risen up at about 2.5%, for example, on the 5-year. That's up half a point from when you cut in September. Do you have any concern at all that longer-term inflation expectations are de-anchoring, or put another way, are anchoring at a slightly higher level? Thanks.
So we would be concerned if we thought we saw longer-term inflation expectations anchoring at a higher level. That's not what we're seeing. We're still seeing, between surveys and market readings, broadly consistent with I looked at the 5-year earlier today, and it's probably moved, but it's just not. It's kind of right where it's been, and also it's pretty close to consistent with 2% PCE inflation. So that's one that's been a traditional one that we look at a lot. But overall, expectations seem to be, and really have throughout this, in a place that's consistent with 2% inflation. But you're right to say we watch that very carefully, and we will not allow inflation expectations to drift upward. But that's really why we reacted so sharply back in 2022 was to avoid that.
Kelly.
Come on, guys.
Hi,
Come
Chair
on.
Powell, Kelly O'Grady, CBS News. We just talked about what you've heard from business leaders on the economy, but many average Americans are still not feeling this.
What's going on?
So what's your message to them on when they might expect relief?
So you're right that we say the economy is performing well, and it is, but we also know that people are still feeling the effects of high prices, for example. And the world went through a global inflation shock, and inflation went up everywhere, and it stays with you because the price level doesn't come back down. So what that takes is it takes some years of real wage gains for people to feel better. And that's what we're trying to create. And I think we're well
Lots of liquidity at 77.
Down. The economy is still strong here. Wages are moving up, but at a sustainable level. So it's just, I think what needs to happen is happening, and for the most part has happened, but it'll be some time before people, regain their confidence and feel that. And, we don't tell people how to feel about the economy. We completely respect what they're feeling. Those feelings are true. They're accurate. We don't question them. We respect them.
And just a quick follow-up, President-elect Trump has been critical of your performance. Any concern about his influence on the Fed's independence?
I'm not going to get into any of the political things today. But thank you.
Dang.
I'm bullish on her.
Hi, Chair Powell, Nancy Marshall-Genzer with Marketplace. What is your plan if we start to see stagflation?
So that's the whole plan is not to have stagflation, so we don't have to deal with it. So that is actually our plan. It's a very difficult thing because anything you do with interest rates will hurt one side or the other, either the inflation mandate or the employment mandate. I would just say that we've been able to see inflation come down a whole lot, much closer to our goal, without the kind of sharp increase in unemployment that has often accompanied programs of disinflation. So, knock on wood, we've gotten this far without seeing a real weakening in the labor market, and we believe we can complete the inflation task while also keeping the labor market strong, and that, of course, is exactly what we're trying to do.
Can you rule out an interest rate hike next year?
No, I wouldn't rule anything out or in that far away, but that's certainly not our plan. I mean, our baseline expectation is
interest rate hike next year
to move gradually down towards neutral, that the economy will continue to grow at a healthy clip, and that the labor market will remain strong. If you look at our that will not change from the September SEP. That is our baseline forecast, and short of some exogenous event, that will continue to be our forecast for the foreseeable future. So. But ultimately, we're not in we're not in a war where we can afford to rule things out a full year in advance. There's just too much uncertainty in what we do.
Shoot it, Jean, for the last question.
Okay, come on, send it to zero.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to go back to a comment that you had made about Americans being quite unhappy about the cumulative price level rises over the past few years, even though now inflation is back to 2%. Would it be appropriate for the Fed to undershoot for a while on its inflation under the average inflation targeting regime, so people have a chance to catch up?
No, that's not the way our framework works. We're aiming for inflation at 2%. We do not have to deliberately undershoot. And
I really like
the
this.
problem there is
I like that.
low inflation can be a problem too, in a way. But that's not part of our framework, and it's not something we're going to be.
Yeah.
Thank you very much.
See that juicy zone to the upside? Yeah. Anything up to 77,300.
Yeah.
Oh, it's a wrap. It's a wrap. Sure. Okay, guys, if you are still awake, okay, let's get the music back on, because I can't even think. I feel like I'm in a cave after that speech there. Let's get that going. There we go. Okay, Dave is back. Ray is back. Okay, that was a pretty, it came out pretty flat, didn't it? I mean, we don't have any action here. I was looking for a candle. Yeah, I found that that liquidity zone at 77, just above that, and I thought maybe we get a pump into that for a little short there. But guys, there's no trade at the moment, unfortunately, here on BTC. Pepe short is red, Pepe long is fucking green. Injective short red, Sui's flat, Sui long's cooking.
Radium short is printing.
Radium short is printing. Taro short's not bad. Sol, I mean, look at this Sol. It's absolutely flying.
It's amazing.
Let's see our Radium's nice. Okay, so yeah, anyone shorting, just watch out the highs. You got to give it a gap over the highs there in case we are going to get something rolling over here. Just to recap, there's things like Phantom. We covered multiple reasons why this was a big rejection area, and you can see it's a resistance band now for Phantom. So a little bit of caution at the top there on Phantom. Sol, also a bit of a danger zone here for Solana. You can see what's going on at the moment. So Sol upside targets 204 if we don't fall over here. And then remember, if we do fall over on Sol, let's just try and find you guys a reasonable area here. It's not tying in nicely just yet, but 172, that sort of level, you could probably start sniffing around if it's a heavy sell. Alternatively, at 182, those types of things you can dial in. Solana traders, okay, just keep dragging this fib from the lows to the highs. You want to get the tie-in where you get nice tie-in with other things like VWAPs and moving averages and those things. You want to get the tie-in on those areas. When you do, that becomes a hot zone. So Sol here, you can see 181 on the 1 hour time frame. That's a hot zone at the moment. So as this price starts moving higher, most likely we're going to get a rejection maybe at the next zone. So look out for 204. That's a potential danger zone there for me. Then we'll adjust these fibs. We'll try and figure out where we get some good tie-in on Sol. But right now for me, Sol traders, 181, that looks okay. And I'm loving this ETH. So yeah, I think there's an ETH situation brewing very quickly. I think ETH has been ignored for way too long. And anyone who wants to trade ETH, your main support now, 2766 and then 2688. Those are big levels there for ETH. And this is a major ETH break here. So looking for something like this, rejection on that 200-day MA, somewhere around that region, then maybe that type of bullish pullback we're looking at on ETH. But yeah, nice to see ETH coming alive. Dave, you want to leave us with a setup here? Do you have any setups going on?
What are you looking for, a long or a short?
Whatever you got, whatever you're seeing.
Okay, I mean, there's a couple things I'm seeing. Let me share my screen here.
Rinse is shorting Popcat at the moment. Let's see, nice little pump. Let's see if it can. Let's see if it can carry on going. Okay, Dave, bring your screen up there. Let's see what Dave's got here for us.
Okay, give me a second. So for a short, I'm looking at OM. basically did a fib pull from the top to the bottom here, very top to the very bottom wick, and you can see this trend line is being respected. We also had a sniper zone reaction. So that's a short hedge play potentially. Remember,
what's the
Bitcoin's at
entry
all-time
zone there?
highs. I would say like 147-ish, 146, all the way up to like 148. If we start to do this deal though, then we're actually breaking trend and we're gearing up. I had my eyes on a Zeus long, but it didn't really come down to my entry. I was actually getting ready to post this in the Sniper Club. So I've got my eyes peeled for that on a bullish pullback. Somebody also mentioned in the chat about ICP. It hasn't really moved yet. Kind of keeping an eye on it as well. But I think if we get any kind of pullback like this is kind of our entry for ICP. I don't think it's ran yet.
What's that level there?
135 to 143-ish. Target would be the 200-day MA. Just kind of track this momentum line, if you will. We've had a reaction off the 786 already. And like, yeah, ICP has not made a move yet.
Okay, so I mean, at the moment, I've seen a pullback long opportunity and a short opportunity. So I think, yeah, that's kind of the feeling out there at the moment. Now, I mean, if the market rips again, guys, remember at some point we're going to get those pullbacks. At some point we're going to get those bullish pullbacks. If you're trying to long these zones right now, it can get a little bit risky. And it depends how much you can stomach when you do get some kind of reversal. At some point, we do get that reversal. The liquidators come and they come grab the late longs and they flush everybody out. So just be safe out there. And if you are, if you are trying to trade here, let's not go max leverage on everything at these types of zones. Let's wait for some bullish areas first that we can play with. But yeah, I like this OM setup. And you guys, I mean, for those of you that don't know, you haven't seen David. He's a graduate of Sniper School. Okay, and now he's one of our lead traders in Sniper Club. He's a Bybit competition winner, and when this man gives a trade, we listen to this man. And there's another cohort around the corner, I think, for Sniper School. It's on the 17th of November. So if you guys want to learn how to trade, you want to learn how to chart and do things like you see, do things like us. Well, there's a link in the description there for Sniper School, cohort 17. No. November 17th, cohort, I think it's cohort 7, but you can join. It's absolutely free. They teach you how to trade. Absolutely free trading course.
You gotta do it.
Yeah.
So
he's a graduate.
Yeah, it was a game changer for me. If you guys have never taken any kind of trading course, I highly recommend taking it. Just so much good information, and what's crazy, it's free. Like, you'll never hear that. So
yeah,
don't wait around.
Okay. Well, Davey, thanks for hanging, guys. Ray, thanks for hanging. A little bit of a flat speech. I mean, it was nothing happened. Okay, market's flat at the moment. Let's see what Asia does now with this information. You've seen that liquidity zone at the upside there, just above 77,000. So that is a bit of a hot zone. If they do pump it there, look out for that sell-off there. Look out for that rejection in that zone. And now you do have some key Bitcoin levels that you can work with. If you want more detailed altcoin level charts, watch my show from Banter Plus earlier today, about 3-4 hours ago. I gave detailed setups there. And then obviously Sniper Club members, all those charts are in Sniper Club. Okay, so everything you've seen on the show tonight, all the exchanges, all these things we're using, it's all under the show description, guys. You can grab it over there and jump in there. Guys, I'm back tomorrow. Banter Plus, let's see what they give us. And trade safe. Just be careful out there. Okay, things are hot at the moment. See you guys later.
No liquidation alerts today.
And you get rinsed yet, bro.